Yesterday, we talked about a young couple who were starting their investment strategy using ETFs. We're going to spend a little time diving into exchange-traded funds, or ETFs, and index funds. You may have heard of investing using these strategies. Today, we're going to talk about the similarities between ETFs and index funds. Tomorrow, we will dive into what an expense ratio is. Then we will look at some of the differences between ETFs and index funds. Both of these are popular investment options that allow investors to gain exposure to a diversified portfolio of securities at a relatively low cost. You may find both an ETF and an index fund that track a specific market index like the S&P 500. When we look at differences between these, you'll see that they differ in structure and trading mechanisms. So to dive into the similarities, both ETFs and index funds offer inherent diversification by holding a basket of securities, which reduces the risk associated with investing in individual stocks or bonds. Both are passively managed. They aim to replicate the performance of an underlying index rather than relying on a fund manager to actively select securities and try to beat the market. This results in lower operating expenses compared to actively managed funds. Both have low expense ratios or fees, which benefits long-term returns. Both ETFs and index funds have had strong historical long-term returns compared to actively managed funds. What are other similarities of these that you can think of? Comment below.